What a week it has been. There was a lot that happened this week. I should say, what hasn't happened this week. I want to talk a little bit about copper, what happened with cattle, unemployment, why the market fell on Friday, what happened over at the Fed. And then at the end, I'm going to get into a little bit about my thesis on where things may be headed from a rate perspective, as well as where the market may be headed. So with that, let's jump in. First thing we're looking at here is copper and the London Metal Exchange prices. This is the spread in between copper's futures as well as the physical delivery of actual copper. There's not really a copper glut. There's no problem with copper supply in the world, in the global economy. But what happened over the last several weeks with the expectation of tariffs is that the copper's futures prices domestically started pricing in the impact of tariffs. And what you're looking at here is the average over the last several years. And when you look at the copper's future price compared to the actual physical delivery of copper, you're about 50 cents a pound difference. So copper might be selling for, say, $4.25. Copper's futures prices are roughly, $4.75, roughly, 30, 40 cents, 50 cents above the actual physical delivery. What happened, though, was Trump had indicated that there was going to be some tariffs on copper. And as a result, over the last several weeks, the futures prices started to price that in. And what ended up happening, let me go and jump into actual copper prices. Over the last, we're looking at actual copper futures prices. And you can see it's roughly about $4.65 a pound in May, April and May. And then all of a sudden, the announcement of tariffs on copper came into play. And what ended up happening is market participants, whether that's people who deal with copper, they started bringing in copper ahead of the tariffs. They were front running the tariffs. They brought copper in. They started storing it in warehouses because they thought that the copper prices were going to stay high because of tariffs. Remember, physical copper didn't change. It's not a supply and demand thing. It's strictly just based on the tariffs. So you can see that the prices jumped. Here's first part of July. We're going from now $5 a pound up to all the way up to $5.82 a pound on copper, when the actual physical product is only selling for about $4.40 over in London. This was the spread widening. There was an arbitrage of where people thought the prices were going to stay domestically. Look at what happened here. So now you have this huge variance with copper compared to the actual product. And Trump on Wednesday, July 30th, announced the tariff. He said that it's a 50% tariff on semi-finished products, not the actual copper itself. So if you think of like copper pipes, wires, rods, tubes, anything like that, that's where the tariff was, not on the copper itself. So that caused the market participants to completely unwind their position because now it became worthless. That means copper is still going to sell at the physical price of copper over on the London Metal Exchange. This was the largest drop ever in one day. So that spread went from $1.60, remember it was $5.82. Well, the actual price of copper is much lower than that. When that tariff came out on Wednesday, and it was a clarification on the tariff, there was a lot of people who lost a lot of money. Each future contract, 1 penny is worth $250. So this differential going from $1.40 down to like 30 cents in one day was roughly worth like 35 grand per 25,000 tons of copper. That's a huge loss, not including all the people who paid extra just to bring it in and store it into warehouses locally and then paying the storage cost. I mean, there's a lot of people who lost a lot of money on this. So big news in copper in that the tariff only applies to semi-finished products and not the actual copper itself. So hopefully, if you were trading this, if you were a market participant, hopefully you didn't lose your shirt on this one. Retail investors can't really play in this game because we can't trade LMEX. It is mainly for big guys, institutional players. So that is an interesting take, though, on what happened with copper and LME. This is just a historical move that happened with tariffs. I'll get into some more about tariffs here in just a second with cattle. So speaking of cattle, Remember a couple weeks ago I talked about the cattle and hog spread, the differential in cattle prices compared to hog prices. Again, it's tariff related. It's also screwworm that I talked about a while back. There's the screwworm that's causing havoc down in Mexico. So it's a perfect storm. You've got two big things affecting cattle prices, which is causing that spread to go and widen even further. So I got into the trade roughly around that 134, 135 mark, because again, this is historical. It's never been this wide. It's usually around 60 to 80 cents, and now it's $1.40 apart. So I got into it around here. I did a little bit of hedging, and I brought my cost basis up a little bit, but still, it was still going against me. It still kept moving. So here we are at around the $1.43 mark. I took a little bit of a loss here. I went ahead and got out of the position because I'm thinking, well, man, we don't know what's going to happen with the screwworm. We don't know what's going to happen with tariffs. The Brazilian tariffs went into effect. That was 50%, and there could be more. So I went ahead and hedged my bets. I closed out at a little bit of a loss, but I'll show you how I'm going to work out of it here in a second. Let's look at cattle prices itself and not just the spread. So here's the cattle price. We talked about the screwworm. We talked about Mexico border being closed to cattle imports. Back in the May, June timeframe, the border was closed, and then late June, early July, the border reopened to cattle imports. I talked about that in my previous video. So that caused cattle prices to fall. 2 days afterwards, the border was closed, and that caused cattle prices to shoot up again. And then we had the 50% tariff against Brazil, causing prices to go up even further. Look at this. On July 30th, right before July 29th and 30th, Trump decided to put even more tariffs on. He added an additional 40%, and that caused cattle prices. He released that at like 12 o'clock or so Central Time on Wednesday. The prices shot up through the roof and went all the way up to $2.30 a pound. We're talking record high prices for beef. It's never been this high. The very next day, there were some concessions on tariffs, and so like nuts and fruits and several of these Brazilian tariffs, where we thought we were going to have 50% or 90% total, a lot of it was exempted. So the market's reaction was, well, holy crap, if he's putting all these tariffs on and then he's already conceding, there's a lot of room for negotiations. So negotiations hadn't even happened, and yet there were concessions made. That caused cattle prices the very next day on Thursday to drop like 6 cents a pound. Well, each contract is $400. So that's $400 per penny drop, which that was a $2,400 drop per futures contract. That's a big drop. In fact, it unwound several days worth. Who knows where cattle prices are going to go from here? What's going to happen with Brazilian tariffs? What appears there's some concessions. What's going to happen with the screwworm? If the screwworm continues to migrate and make its way north, if this fly continues to make its way north. Now, some are saying that the border is going to reopen in September. We'll see. Don't know about that yet. I haven't confirmed that officially. These are just some rumors that I've seen out there. We don't have an exact date. If there are no more cases in Mexico of these flies, then perhaps you'll see an opening of the border, and that'll allow more cattle to come in. If these tariffs drop, that'll allow more Brazilian imports of beef. That should be supportive of cattle prices coming down. We shall see. We'll wait. I do want to show you how I'm playing this, because I did get out of the hog and cattle spread, but I'm going to just dive in, so bear with me just a second, because for those who might be following this trade, imagine taking this right here, these prices, instead of being on the y-axis, I'm going to put it on the x-axis, okay? That's a terrible line, but let's say this is 215 for the cattle price, and this is like 235 or 245. What I've done is I am actually doing I'm actually doing three things. One is I have straddled this to where my profit looks like this. As long as the price stays in between 215 and 235, I'm going to be profitable. And I did that for 30 days. This will pay me something. I will call this $700. Okay. So in the regular position, I lost about $4,000 from it from that price going up. I didn't want to lose any more, so I just went ahead and closed out at $4,000. $4,000 hickey is what I took. But what I did is I entered one of these straddles for 30 days out. That'll give me $700. The odds of it going down to 215 are probably very, very low with the fly and with tariffs. The odds of it going to 235 in 30 days, maybe. There's a risk. I'm going to take that risk. That would be really high prices. Considering it already fell, I don't think it's going to go to 235. We'll have to manage it if it does. The other thing I did was a condor. So let's get out of here, and I'll show you where I'm going to really make the money. Okay, so condor looks like this in terms of profit. It's kind of the same thing. But what I did instead was I set this up so that, actually I should redraw this part here. I'm going to do this. Because what I set it up as is this is now down to 205 by November. So this one, the earlier one was 30 days out. This one's 90 days out to give me some time. If the price stays above 205, no matter what, I make a profit. I set this up at, let's call this $225. So as long as it stays above 225, as long as it stays up above 225, this is going to make $680. If it goes below here, which is roughly 220, down to, I think it's 209, anywhere in there, this is a $5,300 profit. And I did that because, I don't think it's going to go down to 205, 209. Anything below 205, well, I have risk here. I think the risk is like 10 grand. So I'm going to take that risk because I don't think it's going to go down to below 205. And if it does, the third position I put in place, you guys are going to love this. So I've got 680 here, that if it stays above 225. I've got 600 and something if it on the other one, that's the condor, where I split that between 235 and 212, I think, 215. So I have that one. So that's 600, roughly 12, 13, $1,500, somewhere along in there. Just doing some quick math. The other thing I did is I bought a bull put spread. I mean, not a bull put spread, a bear put spread. So what that looks like is this. This will be hugely profitable as long as it stays below 220. So if it goes all the way down like this, my cost for that was $1,800. But I will make all the way down to 200. So all of this, the further it goes down here to 200, the more money I make. And the idea was behind that is that will take up that risk of 10K that I was going to lose if it goes down below 210. Remember on the previous one, so I have three positions. One is just a strangle, where I said, well, give me some money back as long as it stays between 215 and 235. So give me $600 back there. Then I entered this bear put spread where I'm going to make, I'm going to spend $1,800, but I'm going to make up to $10,000, $15,000 on the downside. And then I said, give me a condor so that if it stays above 225, well, I make $600 there. I pretty much paid for my $1,800 debit spread. I've paid, because I've got the one that I'm going to make $600 or $700. I've got the condor, which is $600 or $700. That's going to pay for almost all but $600 of this $1,800 spread. If this $1,800 spread goes in my favor, that makes up 10. I make up 5 on the other one. And if the beauty is, if it stays above 210, I'll make 5 plus whatever this thing makes, which will probably be another 5. But if this goes all the way down to 200, well, then I'll make up the loss that I'm going to lose on the original condor position. Bottom line is, I have a very low risk play now, waiting for this price to come back down into this range. As long as it doesn't go, well, even if it goes all the way down, if it goes all the way down to the 205, well, I probably won't make much because I have the condor that's going to lose money. But I'll at least make something. I'll make at least probably $1,000 back at a minimum of my original $4,000 loss. But if I'm lucky and I close in between here and here, which, look at this, all the way back to here, Look at that range. So this is a support level right here. So I am good, and I'm hopeful that it will go back into this space. And if it does, I will make all the money that I lost and then some. If it stays up here, which I don't think it will because I do believe the border will reopen. We know that the sterile fly thing will work. So I don't think it's going to go up there. And if it does, well, I'm only going to lose $600 because everything else is going to make up for it, right? So that's very complicated. If you have any questions, please drop a note down in the comments. I can explain it. Give me a phone call, whatever. I can explain it in very, very much detail. But I wanted to show you just quickly how I set this up so that I can recoup some of the loss of the hog and cattle spread trade. All right, so let's jump to the next thing, FOMC. This was interesting. So Wednesday we had the FOMC meeting. Remember, they meet every 6 weeks and set monetary policy on where they think rates should be headed. There's a couple of things that I highlighted. I won't go into all the details, but these are the differences between what they said in June and what they said in July. So first was they said in June that the economy was expanding at a solid pace. That's growth. Because of GDP and what had come out earlier this week, they said growth of economic has moderated in the first half of the year. So it's not as strong as expanding at a solid pace. So there's some weakening in the argument of keeping rates higher for longer. The other thing is they said that uncertainty, this was related to tariffs back in June, has diminished but remains elevated. Now they're saying it just remains elevated. But what's the most important thing to me, and the most important takeaway, was the policy decision back in June was unanimous to keep rates flat. This time it was split. There were two dissenters, Michelle Bowman and Christopher Waller. They both said that we should cut rates 25 basis points in July. This is super important. This is the first time this has happened since 1993 that you've had two dissenters. This is a big deal. There's some weakening in the voice at the Fed that there will most likely now be a rate cut in September due to this. And I'll get into that in a second with unemployment and what happened with unemployment and why a rate cut in September is almost certain. So Michelle Bowman and Christopher Waller have both been appointed by President Trump. They were both appointed in 2018. Is this a political play? Who knows? Michelle Bowman is now vice chair. We know Jerome Powell is stepping out in May. So is Bowman, trying to placate Trump because Trump wants rates dropped? So she's like, maybe this is my way of getting in to become the Fed chair? Who knows? I don't know. But she did dissent. She wants a rate cut. This could be seen favorable in Trump's eyes. And she could be, I don't know, but she could be considered for the Fed chair. So maybe it's a political play. Who knows? There is some weakening in the data. I've been saying that for some time. I've been saying why not play the short-term rate, because I do believe that there's weakening, and I'll get into that here in a second. The other really interesting thing was Adriana Kugler just resigned on Friday. That's pretty fascinating. So you had two dissenters. By the way, she was not present and she did not cast a vote, but she resigned on Friday. Fascinating, right? So here's what happened. So the FOMC meeting, Jerome Powell gets up there and he's speaking about being very conservative. He's like, we don't want to preemptively cut rates. And he sort of said during his statement, his presser, he was implying that the Fed is going to be patient. And as such, look at what happened to the overnight rate. The overnight rate expectation for December went up 10 or 15 basis points. It almost took out one entire cut. Remember, on this week earlier, we were expecting 2 cuts by the end of the year. When he spoke, then the market went down to 1 cut by the end of the year. So it almost went up to I think it was 403 or 404. Well, if we know we get 1 cut, it's going to go down to 408. The current overnight rate is 433. Subtract 25 basis points is 408. Well, this migrated on Thursday, migrated all the way up to 405. So it was really beginning to price in 1 cut for the rest of the year. Then unemployment happened and it tanked. This is what I've been talking about. is there is weakening in the data. And I'll get into that in a second. And we'll look at several things that I look at. I'll go through it really quickly. But there are several things that I look at, and this highlighted it. And the market went from one cut down to two cuts in a single day. Back in first part of July, June, I had said that I was long on the overnight rate. You can actually go out and buy this futures contract. You can go out and buy it ZQZ 2025. You can go buy that futures contract, and for every contract you hold, for every basis point that it drops, it's worth $41.67. So 25 basis point move is worth roughly $1,200. So this was a big move. After a while of kind of waiting for it, what I didn't like is that I wasn't getting paid anything. So I swapped it out for something else. I'm sitting here and I'm holding this, I'm holding it. I've been holding it for a long time. And I thought, why not swap it out with something else that has some optionality? This has zero optionality. So you go spend $1,500 per contract and you hold it. And if you bought this thing at 96, I think I bought it for 96.46. That was the May contract. And I just sit and wait. It's got 3 cuts priced in. I'm waiting for that 4th cut. I'm waiting for some news to come out like this. I don't get paid while I'm waiting. And I wanted to get paid. So I thought there's a better way of doing this. So I'll show you how I did that. So this is how I did it. If you look at this blue line, this is the overnight rate. And this is what I've been trading. But I decided to swap it out because there's no optionality with the overnight rate. I can go buy the contract, but I just got to sit and wait. I don't get paid. When I sell option contracts, I actually get paid to wait. So it doesn't hurt. And I thought, well, let's just do it this way. Well, you can see that the overnight rate and the 2-year rate is highly correlated. You would expect that. The overnight rate is just that. It lasts for 1 day. Well, the Fed's been keeping it here for several months at 4.33. The 2-year rate is tightly correlated and has very little duration risk. Duration is sensitivity to interest rate changes. It has very little duration risk. And so that rate, if you look, let's just go back to March, is roughly 364. The overnight rate for the end of the year was 399 is what was expected. So about a 25 basis point difference. You can, just by that, you can infer that the 2-year rate has a couple of cuts inside of it, because technically speaking, you'd expect the overnight rate to be one thing and the 2-year rate to be higher than it, because you're holding something longer. So you would naturally think that the rate should be higher. Well, if it's lower than the overnight rate, then that means the 2-year has already priced in a couple of cuts. If you look at the Fed Watch tool, you can see that those cuts are being put in place, or they're being priced in. So just naturally speaking, you know that there's some cuts implied. And so it's already priced into the 2-year, so you can't really get ahead of it. It's already priced in. But what I can do is I can sell puts against the 2-year, basically against the 2-year bond, and collect premium while I wait. And you can see nothing's really happening. It's just kind of hanging out here around that 4% at the most, right? Both what the expected terminal rate is as well as the 2-year rate. So what I did is I swapped it out and I said, well, rather than trading the overnight rate, let's just sell some puts on the 2-year. So I can't sell puts directly on the 2-year bond. I can sell puts on a 2-year contract that represents the bond. And this is this component here. So here it is. This is ZTU 2025. Now, it represents a $200,000 bond paying a 6% coupon. If you have detailed questions and you want one-on-one, I'll be glad to walk through this with you. But this represents, this line here represents roughly the 4% mark. 103, let's call it 103.15. If we go back here, look, this is end of May or middle of May, June. Look, let's go back here. Middle of May, there's 389. Middle of June, 392. So it's inverse, right? So you can see that this part here represents roughly 390 to 4. So what I've done is I went and I swapped out my overnight to a 2-year bond, because it's extremely correlated. And I said, well, let's sell some puts on it. So I sold a put at 103, call it 103.16, 103.5. And then I went and bought a put down here. We've seen this in some of my other selling puts videos. Well, I'm selling optionality here. So as long as it doesn't go above 4%, this line here, this is my support. As long as it doesn't go above 4%, I'm getting paid to collect premium here while I wait. And I took what I was selling these for and I bought a call. I bought a call at roughly this 103.16. I bought a few calls at different places at 103.75. And I held these calls because I'm getting paid here. And I bought enough calls that it was kind of a wash while I waited. Well, then when the market has the news that I'm looking for, like unemployment, well, then it went through the roof and it priced in one cut. That's a 25 basis point move. It went from 103, 0.161 to 103. Oh, actually, it went up to 104 at the end of the day on Friday. So that was a big move, 16 basis points, something like that in the 2-year. Well, let's just go look at the 2-year. And we were, let's see, the 2-year. The 2-year was 396 and then down to 368. So yeah, year 26, 27, 28 basis points. 28 basis point move. And all I did is I just paid for it with this. So I was getting paid to do this, collected some premium here, bought this call basically for free. And my risk was that if it went to 425, well, then I would have lost on both the call and this put spread. But knowing where I know rates are headed, I took that gamble all day long. So that's how you can do it rather than trading the overnight rate directly, which you can do, just buy and hold. But I wanted to get paid to hold. So that's why I did that. All right, let's jump into unemployment and let's see what happened there, because this was the moneymaker. This is what caused everything to happen. Now, before we get ahead of ourselves, this is one report. There is a trend of weakening data, but there's a lot that can happen between now and then. So don't just go out and start buying calls on the 2-year or the 20 or whatever rate thinking that that rates are going to fall and plummet. It might not happen. It may hang out where it's at. It might even retreat a little bit, especially if inflation comes in hotter. We don't know. That's why I like puts, because it gives me some margin to work with and I can collect some premium. But let's take a look at what caused the market to move. I'm going to show you what I look at. There's a lot of data here. Talks about where the ads were. We'll go look at the data itself. A lot of times you'll see the market pay attention to headline. What the top line number is 4.2% unemployment and so many people unemployed. I like to look at the data itself. Here's what's important. This is what drove markets here. So the change in total non-farm payroll employment for May was revised down 125,000. So previously it was reported at 144,000 job ads, and now it dropped to 19. Dang, that's a huge number. And then this one, look at, that was May, this is June. It went from 133,000 ads down to, 147,000 job ads that we were told, all the way down to 14. So that's bad news. So you can expect that there's a lot of downward revisions. I've done videos before on the downward revisions. There's a lot. And so we have July data, but we'll probably see some revisions downward. We saw a 73,000 job ad. They were expecting 140. Now it's down to 73. And that's what caused markets to move. We'll probably see more adjustments in the future. So that's bullet point number 1. Another thing, participation rate fell. Look at that, 173.42 from 173.80, so down 38. The number of unemployed people went up, 221,000. Not good. Let's see. And here's employed people. Number of employed people dropped. The number of unemployed went up. These are the not good things. Let's go down this here, average weekly hours. This is a positive. We had an increase in hours there. That's more productivity, more money coming into the market. Average hourly earnings, we had an increase. And then let's go down. We'll go down Going to go down to distribution of workers by degree type. So June, 9,000 high school, less than high school. So we had an increase, slight increase there. High school graduates, no college. We had a decrease here. Maybe that's because people are, moving out of the workforce, going back to school, maybe going to college, who knows. But there was a drop there. This stayed pretty flat from associate's degree or some college. That stayed pretty flat. That's good. This is a good news story. From bachelor's, you had more increase in bachelor's, so 67,178 compared to 66,761. So what is that? About 400,000 more employed people with bachelor's degree. That's a good thing because those are higher priced employees contributing more money to the economy. Another positive is the part-time workers or multiple job holders. So looking at this, not seasonally adjusted. So we're going to go from July of last year to July of this year. There's actually a decrease. So not as many people holding multiple jobs. That's positive. I'll take that. Seasonally adjusted, 83.42 compared to 84.75. So either way you look at it, that's a positive. And then we'll go down and look at multiple job holders. We just looked at that. Let's see. Okay. Now we'll look at the establishment data and see where the ads were. So private, all in, we had 73,000, but total private was 83. So that means we had a loss in government. Go back a couple of years, and we've had ads in government. All right, so looking at government, let's see where the drops are. So we have federal, 12,000. We have federal except post office is 14,000. So post office added 2.4. State government added 5. Education is down. Local government education is down. There was a big plus up in education last month. And then you've got to go through. Let me go back to the top. You can see where some of the ads for private employment are. 2,000 in construction, 11,000 in manufacturing. That's kind of interesting. We've been seeing some weakening in manufacturing, like the ISM and PMI reports. And non-durable goods, down 11. Service producing, this is where we have inflation is on the servicing side. Anyways, so you can kind of go through and see where things are at if you want by particular category. Another thing I do like to look at is employment services. So these are your recruiters, down 7,000 there, and temporary help down 4,000. So if companies aren't hiring, you would expect to see a drop in recruitment activities. And there you see that. So that's unemployment. All right, so what does all this mean? Where do we go from here? One more thing. This is your percent growth, and I got this all the way back to March of 2024 and what categories are growing, what categories are decreasing. You can see government is dropping. Construction is flatlining, leisure flatline, all private is increasing. Retail was up, transportation is down and then up, and then manufacturing. Well, there's what I was talking about. You've been seeing a decline in manufacturing. This is one of the things that Trump's hoping to fix is bring manufacturing back on shore. And then temp workers decrease here. So what does all this mean with the economy? So this is interesting. Wall Street forecast. So this is if you look at all of these big guys, Wells Fargo, Citibank, JP Morgan, all of these big guys, you got several forecasts of where they think the end of the year where the end of the year S&P is going to be. So there's their initial forecast in January, where they thought the S&P, like the highest one, they thought it was going to be 710. We started the year much lower. It was around 6,000. And then down, some people were thinking, 6,500 is where the market was going to end. That was on the low end. Then the tariffs happened. We all followed each other. And everybody's thinking that, earnings are going to be a whole lot less, with the high one at, 6,300 and somewhere probably down to 5,000. So everybody panicked. We saw the market sell off. And now look, everybody's like, hey, we're back to where we were, up to 7,100 again. With some people saying down to 5,600. That's interesting, but most people are on their way back up. Take this with a grain of salt. It's about as meaningless as a screen door on a submarine. You cannot forecast. Nobody can forecast. So take it for what it's worth. It's just a benchmark. I've been following this for years and they never get it right. So here is how I'm playing it. I don't like to predict the market. I don't like to predict whether it's going up or down every time I take a position. You know how it goes. You take a position and you're like, I think the market's going to go up. And it's like the market looks and says, oh, hey, Josiah just entered. And the market goes against me. Or if I think the market, I'm going to short the market goes against me, it goes up. Always does the opposite of what I think. So I really don't like to predict. I like to take a neutral play and make money off of selling strangles and straddles. And I'll talk about that here in a second. But I did take a directional play on Thursday. And man, did I get lucky. I took a short position in the market. I looked at the fundamentals. And I looked at a lot of weakening. I've been talking about weakening data. The market was super frothy. It's just been on a tear up. Volatility was super low. So I thought, why not take a short position? It doesn't cost me very much because premiums, there were no premiums. Volatility, when you could buy puts on the market, they were super duper cheap. Volatility was at a 52-week low. So I did see some things, though, on Thursday, and I looked at my put-call ratio. This is how many puts are bought compared to calls, and it was very, very low, but beginning to turn upward. It was actually at a 3 or 4 year low. So nobody was buying puts. So as a result, puts were super cheap, and it was a good opportunity to take advantage of it. So I did that. I looked at some momentum indicators like your moving average, convergence, divergence indicator, your MACD. That was on a sell signal. VIX right here was very, very low, back to yearly lows. So again, to take this position was very cheap. But I did see some weakening in some oscillators, your new highs and new lows. This started showing some weakening. And there were some other indicators that I looked at that did show that the S&P was going up like crazy, but the rest, think of those as the generals, and then the troops, your small caps and everything, they were not keeping pace. So there was definitely some weakening in the market. So I took a short. That paid off very well. Actually, getting up at 5 a.m. on Monday morning, I was very profitable. I made some positioning and ended up getting my puts for free. So that if it completely reversed Friday afternoon, it's no harm, no foul. It cost me nothing. I was able to take some positioning. I do play the futures market, so I was able to take a position at 5 a.m. when the market was down little over 1% overnight. So it gapped down and then continued to go down throughout the day. So what I'm doing now is I'm playing a straddle or a strangle, if you will. And I'm selling calls up here and selling puts way down here. Volatility got super expensive. And when you have a big move like this for a couple of days, volatility goes through the roof. We saw that on VIX. It gets very, very expensive. And as a result, I can sell puts down here where they were selling for nothing. I bought them because they were cheap. Now they're super expensive because everybody thinks the market's going to potentially crash. So I can sell a put down here and I can sell a call up here. So I've got a pretty wide spread of what this thing looks like. I just did this for 1 week. And as long as it stays in between this range, I'm profitable. I also have time decay on my side. So volatility could collapse and time decay will definitely collapse. So I took that position and I will profit off of time decay. If it goes down and continues to drop down on me, well, then I'll hedge, probably by selling more calls up here. But in short, this is my thesis and this is what I'm doing. I'm not going to take a directional play on Monday. One, it's going to be very expensive to take a directional play. By selling these straddles and strangles, I will continue to work volatility and wait for volatility to collapse. If it goes down, well, then I'll probably sell more volatility. If it goes up, good, volatility will collapse, and then I'll collect premium on that. In short, I'm playing neutral. As far as rates go, my other big plays, I closed out my positions on Friday. Those rate positions that I talked about where it spiked, I made handsomely on that. Went ahead and closed those out because it had 2 rate cuts priced in. That's probably about where it's going to land. I will wait for further pullback, meaning rates to go up, and that means bond prices will go down. If that happens, well, then I'll probably enter some more positions. But I'm going to wait it out for a couple of days and see what happens, and I will probably straddle the 20-year. I may straddle the 10-year, and then if it pulls back, I'll probably sell some puts on the 2-year and buy some calls and wait for it to happen again, because there is weakening in the data. Powell even indicated that he is waiting to see if the tariffs are a one-time price bump or do they cause inflation. I've talked about that before. Tariffs, in my opinion, will, and I understand where he's coming from. He's the central bank king. I am not. So he's going to take the most neutral, cautious stance. But I believe that tariffs will cause a one-time price level increase, not a continuous price increase. Once they work their way through the system in the next 2 to 3 months, you will see inflation start coming down again. And that's why I believe that it's safe for me to play these rate plays where I can sell the puts and buy calls. And like what happened on Friday, just wait for bad news. If bad news doesn't happen, no harm, no foul, I still get paid. And for now, on the market, I'm very neutral. So that's it in short. I hope this was helpful. If you have any questions, please drop some notes down in the comments below. Hit the subscribe button. Let me know you like these. I'll continue doing them if you do. And if you have any questions, let me know. Happy trading. Again, do your own research. This is not financial advice. Thanks and take care.